what you see here is the bubble, the tech bubble of 2000, and then the market crash. But right here, we've got the 1929 peak. When that bubble popped, it led to the Great Depression. Then we have the tech bubble of 2000, and this was the real estate bubble. Stocks were not in a giant bubble when real estate went into the 2007 bubble, but when real estate fell apart, it dragged the stock market with it down to what was used to be considered fair value. It never actually visited undervalued. But look at where we are today. On this measurement, we're in the second largest bubble in history. This is the only measurement that you can look at the stock market with that shows it not being in the biggest bubble in history. We truly are in the biggest bubble in history right now.
Global financial markets have entered an unprecedented valuation super bubble, detaching asset prices completely from underlying corporate earnings and fundamental macroeconomic stability. Structural market indicators show equity valuations reaching extremes unseen across modern financial history. Mike Maloney, a veteran monetary researcher and author, highlights that current equity valuations sit 50% above the 1929 market top and exceed the 2000 dot-com mania by more than 30%. Decades of automated payroll contributions through 401 accounts have created persistent passive buying pressure, normalizing inflated price-to-earnings valuations of 30 times earnings, while dividend yields drop to historic lows. Because stock valuations remain extended well beyond long-term trend lines, this structural distortion predicts an inevitable severe market crash that will pull equities back down to deeply undervalued levels, triggering widespread turmoil across the broader economy. Now, we present the clips from Mike Maloney's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
What you see here is the bubble in 1929, the tech bubble in the year 2000, just before the global financial crisis when the Buffett indicator peaked. And then we've got where we are today, which is totally insane. You're talking about 50% larger than the 1929 peak, and when that bubble burst, it led to the Great Depression. You're talking about we're at a probably 30% or more larger than the tech bubble of 2000. And then the financial crisis, stocks weren't really in a bubble during they've been in a bubble this whole century, but they weren't in a super bubble during the financial crisis. The financial crisis was real estate driven. This is another way of looking at the scale of the bubbles. This is the stock market, the dot-com bubble, and where we are today. And this is dividend yields, and it's sort of an inverse indicator. The lower the dividend yield on the stock shows you that if it's too low, you paid too much. So when the price on stocks is too high compared to how much earnings they've got per share, the dividend yield is lower and lower, and it always is lowest right at the peaks of bubbles just before a crash. This was when the real estate peaked in 2007, leading to the global financial crisis. So dividend yields rose when the stock market crashed because the real estate bubble had popped. This is another way of looking at the stock market, and this is just from the Great Depression to today, and this is the S&P 500 index, and I've just drawn a couple of lines around it. And you can see that whenever it hits the top of that trend line, it's usually followed by some sort of crash and a reversion to undervalued. It hits the bottom of that trend line. And we had that here at the tech bubble of 2000. It went above that trend line, and then it touched the bottom after the global financial crisis in 2008. And once again, we are above the top of this trend channel. This is inflation adjusted. It's the same chart, inflation adjusted. However, the consumer price index information only goes back to about 1953. So this one doesn't go all the way back to the Great Depression. But what you see here is sort of the same information, overvalued, undervalued, overvalued, undervalued, way, overvalued again. So it's the same information, inflation adjusted. Now, this is Dr. Robert Shiller's CAPE ratio. It's the cyclically adjusted price earnings ratio. So he's taken the price earnings ratio, so it's the price of a stock divided by the earnings per share of the stock. So how much did it cost you? How much are you getting paid to own it? And what he's done here is taken this information back to 1880. Now the S&P 500 actually only goes to 1950. But again, his researchers compiled information going all the way back to 1880. Now I've been presenting Dr. Robert Shiller's information since before anybody knew who he was. Now it's called the Case-Shiller S&P Index. So Standard & Poor's pays him. But back when I first started presenting this in 2004, he was just a Yale University professor and nobody knew who he was. But there's an average here until you get to this century, which I call the bubble century. And you can see overvalued, undervalued, overvalued, undervalued. And then we go into the bubble century and it sort of became normal to pay double what we used to pay per share compared to the earnings. So now you're paying 30 times earnings instead of 15 being fairly valued. What caused this? This is all passive inflows. It was the 1974 ERISA Act that created the IRA and the 401k. And as time went on, people would have a certain amount deducted every week or month from their paycheck, and it would go to their brokerage account. And the brokerage account, the broker would direct it toward, you'd specify you want this much in this ETF and that much in this tech sector or whatever. And so it's just passive inflows with nobody picking a stock or deciding exactly. It's just constant cash going in. When you have more cash going into a market than coming out, it has to rise. And so it's that simple. This is a brainless thing, and it's caused what I call the bubble century. And what you see here is the bubble, the tech bubble of 2000, and then the market crash. But right here we've got the 1929 peak. When that bubble popped, it led to the Great Depression. Then we have the tech bubble of 2000, and this was the real estate bubble. Stocks were not in a giant bubble when real estate went into the 2007 bubble, but when real estate fell apart, it dragged the stock market with it down to what was used to be considered fair value. It never actually visited undervalued. But look at where we are today. On this measurement, we're in the second largest bubble in history. This is the only measurement that you can look at the stock market with that shows it not being in the biggest bubble in history. We truly are in the biggest bubble in history right now.
Beneath headline equity markets, the private credit sector is deteriorating under substantial balance sheet pressure. Default rates in private credit have climbed to 9.2% before any official financial crisis has even begun. Commercial banking institutions place excessive reliance on prime consumer loans issued to white-collar professionals to anchor their assets. However, rapid workplace restructuring poses an immediate structural hazard to these traditional prime credit portfolios. Simultaneously, commercial banks remain weighed down by vast portfolios of fixed-rate Treasury securities accumulated during zero-interest regimes. In a persistent inflationary climate, these depreciated assets generate yields far below consumer inflation, behaving like certificates of confiscation that lock up institutional capital and undermine overall banking system liquidity. Now, let's get back to the interview.
This is private credit defaults, and so you can see 2008, the bank loans. This is COVID. This is a private credit 2024 crisis, and here we are today at 9.2%, and the crisis has not yet started. So you can see how much bigger it is right now, pre-crisis, than it has been ever in the past. This is the portion of loan receivables that are 60 days or more past due by credit type. So you've got prime down here, this peach line. You've got subprime, and hopefully the banks learned their lesson from the global financial crisis of 2008. Subprime is already up here. Ignore that little box. The thing to pay attention to is this peach line down here. That is what banks are counting on. That's what makes up a large portion of their balance sheet. That's what they trust in. This gives them safety. All these prime loans to all of these middle class and upper middle class white-collar workers and so on, 1 out of 4 of which will be replaced by AI very shortly. This thing is going to be doing a hockey stick, and that is the only thing the banks have that they feel is safe. And they're not looking into the future and seeing that. In a couple of years, this peach line is going to be going up to where that red line is. Now, this is the condition of the banks. This is their balance sheet as far as the bonds. They all have to carry treasuries on their balance sheet and other bonds, and whether they're upside down or not. If interest rates were 0 and they've got a bunch of those bonds that are paying 1%, and then we raise rates, those old bonds are worthless. They're not worthless, they are worth less, a lot less. You can't sell them in the aftermarket as easily because nobody wants, when you're in an inflationary environment, and you've got a bond that's only paying 1% and inflation is 3% or 4%, that means, back in the 70s and 80s, they called U.S. Treasuries certificates of confiscation because they confiscated your wealth. This is how upside down the banks are right now. This is the global financial crisis of 2008. They were barely upside down. This time it is global. This is residential real estate in China, and over the past 2 years, it's already fallen 25%. And this crisis is going to affect the entire world. This is going to get a lot worse. This is the probability of one measurement that predicts recessions, and it's done a marvelous job. 1, 2, 3, 4, 5, 6. It's done 6 out of 8 of the past recessions. It's accurately predicted. And what it is the rate of change when you have a sudden deviation in energy prices from the trend. Trend is going like this, and then suddenly there's like a 50% increase. And when it gets over that 50%, we almost always have a recession. And there's where we are. Now remember, a recession is a trailing indicator. You have to have a couple of quarters in a row of GDP contraction. And so they can't tell you that we're in a recession until we've already been in it for at least 6 months. But sometimes it takes a year for them to say, oh, there's a recession. And I want to just remind everybody that we're starting this crisis, with the highest levels of debt to GDP since World War II and the highest interest payments ever. So we're starting off from, this is just reckless spending by all of the politicians, getting us in a suicidal debt. And this is it.
International property contractions, volatile energy commodities, and record sovereign obligations are placing immense pressure on the global macroeconomic framework. Residential real estate valuations in China have already contracted by 25% over the last 2 years, sending deflationary shocks through interconnected international markets. Historical commodity metrics further illustrate systemic economic stress. A sudden 50% spike in energy costs above baseline trend channels has historically accompanied severe economic downturns, accurately tracking 6 out of the past 8 major recessions. Because gross domestic product serves as a lagging metric requiring multiple quarters of negative contraction to be confirmed, official recognition of an economic downturn routinely lags reality by 6 to 12 months. Nations are navigating these challenges while carrying debt to GDP levels matching post-World War II records and servicing the highest nominal interest obligations in fiscal history. Decades of continuous deficit spending have severely depleted fiscal flexibility, leaving central authorities with limited tools to cushion economic shocks. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.